3 things that kill a deal in due diligence. The pitch went perfectly. The story, it landed. The investor was nodding. The term sheet conversation started. Then the due diligence began, and the deal died. Here are the 3 financial red flags that kill deals most often, and none of them are about the business being bad. Due diligence doesn't test whether your business is good. It tests whether your numbers can prove what you already told the investor in the room. Most founders assume a dying deal means a weak business. Usually, it actually means a business that looks messier on paper than it actually is. And by the time that's discovered, the trust is gone. Investors and lenders aren't looking for perfection. They're looking for whether they can trust what they're being shown. The three red flags coming up are the ones that break that trust fastest. And every one of them is fixable before anyone ever asks to see your numbers. Due diligence doesn't test if your business is good. It tests if your numbers can prove it. So do this. Before you watch the rest of this, think about the last time someone asked for your numbers. How long did it take you to pull them together? Keep that number in mind. Let's get into the first red flag, and it's the one that shows up almost immediately. Due diligence red flag number 1, books that don't match the story you told in the pitch. In the pitch, you said the business does $600,000 a year and is growing. In due diligence, the books show something close, but not exact, and nobody can explain the gap. Maybe revenue is recognized differently than you described it. Maybe there's personal spending mixed into the business account. Maybe last year's numbers were adjusted after the fact and nobody documented why, so nobody remembers. None of this has to mean anything is wrong. But an investor doesn't know that. What they see is a story that doesn't reconcile with the evidence. And the moment that happens, they stop evaluating your business and start protecting themselves. Picture the version that plays out most often. A founder pitches a business doing steady month-on-month growth. The deck shows a clean upward line. Then the due diligence team asks for the underlying transaction data. And it turns out 2 of the strongest months included a one-off client project that isn't recurring, plus a chunk of revenue that was actually invoiced in December, but not collected until February, and thus booked against the wrong month. None of that is fraud. It's not great, but it's just how the books were kept while the founder was busy running the business. But now the investor has to go back and ask what else in the story was rounded up or done incorrectly. And those questions can stall a deal for weeks or end it. The fix isn't perfect books. It's being able to explain every gap in one sentence before anyone has to ask. A small unexplained gap reads as a small lie, even when it's just messy bookkeeping. So do this. Pull your most recent management accounts and your investor pitch deck side by side. If the revenue number in each doesn't match exactly, find out why. Ensure the management accounts and pitch deck are corrected and aligned before someone else asks. The second red flag is quieter. It's not about what's in the books. It's about how often you actually look at them. Due diligence red flag number 2, no monthly rhythm. Just numbers pulled together once a year under pressure. If the only time your financials get reviewed is at tax time or right before a raise, due diligence exposes that instantly. Investors don't just want to see the current numbers. They want to see a pattern of monthly actuals reviewed on a rhythm, showing the business being run off real data rather than gut feel. A business with 12 months of consistent reviewed numbers reads as run by an operator. A business with one clean snapshot built the week before the pitch reads as staged, even when everything is technically true. Here's how that plays out in a real conversation. An investor asks casually, "Can you walk me through what changed between March and April?" A founder who reviews their numbers monthly has an answer in one breath. A client paused, a hire started, a one-off cost hit. A founder who only opens their books twice a year has to go quiet, dig through statements live on the call, and come back a day later with an answer that looks rehearsed instead of known. It's the same business. The only difference is one founder looked like they were actually running it because they were. Investors aren't just buying your numbers, they're buying evidence that you actually look at them. So do this. Check. Do you have a dated, reviewed set of monthly numbers for each of the last 6 months? If not, that's the gap to close before your next investor conversation, not during it. The third one is the fastest deal killer of all, because it raises a question no investor will say out loud, but every one of them is asking. Due diligence red flag number 3. Cash and ownership that aren't clearly separated. This is the one that moves fastest from minor concern to we're out of here. It's personal expenses running through the business account. It's undocumented loans between the founder and the company. It's unclear who owns what percentage, or a co-founder agreement that was never actually signed. Individually, founders often think of these as small, fixable admin gaps. To an investor, they raise one specific, unspoken question. If this founder is casual about separating business and personal money now, how carefully are they going to handle mine? That question is unspoken because no investor wants to accuse a founder of anything. They just quietly stop returning your calls. This is often the smallest looking issue on paper and the fastest to sink a deal in practice. A founder pays for some personal health expenses from the business account for a few months because it's easier, fully intending to reimburse it later, and mostly forgetting. A friend lends the business $10,000 to cover a gap, and it's tracked in a WhatsApp thread instead of a loan agreement. When a diligence checklist asks, list all related party transactions and loans, and the honest answer after a pause is, I'd have to think about it. That hesitation is the whole red flag, not the amount, the uncertainty. You're not just being evaluated on the business. You're being evaluated on whether the founder can be trusted with someone else's money. So do this. List anything in the last 12 months where personal and business money crossed paths. A personal expense on a business card, an undocumented loan either direction. Get it documented and separated before it's someone else's question. All 3 of these have one thing in common. They're invisible until someone asks for your numbers. And by then, it's too late to fix them quietly. I've sat on both sides of a due diligence process, and the businesses that pass it aren't the flawless ones. It's the honest ones. As a chartered accountant who has also run my own business, I've been in the room reviewing someone else's numbers. And I've also been the founder waiting to hear if my own numbers held up. What I've seen from both sides is the same pattern. Due diligence rarely kills a deal because the business is weak. It kills a deal because the story and the evidence didn't line up, and nobody had time to fix that once the clock started. The good news is all 3 of these red flags are fixable in advance, in plain English, without a finance team. You just need to know to look for them before someone else does. The businesses that survive due diligence aren't the perfect ones. They are the ones with no surprises left to find. So do this. Pick one of the 3 red flags from this video, the one that made you wince the most, and fix that this week before it becomes someone else's discovery. If you want to check your own business against all 3 before you're ever asked, I've built something for exactly that. I've put all 3 of these red flags, plus the rest of what investors actually check, into a free investor-ready finance checklist for founders. Grab it using the link in the description or comment ready below, and I'll send it your way. Next week, I'm covering the cash flow mistake that quietly kills small businesses and is hiding in a place most founders never check. Subscribe so you don't miss it.